Hi there, this is Brian Christopher. Welcome to another edition of Market Insights. Today I am joined by my friend and colleague, Ian King. Ian, how are you today?
I'm doing good, Brian. Just watching this market in amazement. It seems to go up every single day. We had a shallow pullback, I think, a couple of weeks ago, and then since then it looks like we're heading to a new high. It's kind of amazing. What do you think about that?
It is amazing, and certainly there are some major themes that are occurring in this market today that are actually pushing it higher. Could you talk about one or two of those?
Yeah, I mean, everyone's following Tesla right now, which last I checked was over $1,700, and it's up from about $350 on the March lows and up from $250 last August. And the story here is basically we're heading towards an electric vehicle future. And, our internal combustion engine is going to be replaced by electric vehicles in the next decade. And the reason behind this is not because we have more people who are focused on the environment. It's because more people are realizing that the economic cost of producing an electric vehicle is becoming cheaper than producing an internal combustion engine. There's less parts that you need to produce. There's less parts that you need to fix when you need maintenance on your internal combustion engine. And we're getting to the point where batteries, the price of batteries, which is the highest input cost in electric vehicles, are getting cheaper, and it's making these EVs cheaper to produce. And that's why Tesla is now over $1,700. And it just keeps going up every single day.
And can you talk about their growth? Their growth in China has really been amazing. And actually, even just the construction of the facility over there that they did in just a quick time period compared to every other automotive manufacturing process that we hear about. How can they do that?
Yeah, so the market for electric vehicles in China is about 50 times the size of it is in the United States. And Tesla put together this gigafactory, and it arrived a lot sooner than people expected. And what I want to share with viewers right now is a chart from ARC Research, and it shows that Tesla's share of the battery electric vehicle market in China in 2020 is now 21%, and that's up from 6% last year and 2% in 2018. When Tesla went into China, there was a big question of whether or not Chinese consumers would be buying their vehicles because they're more expensive than China's other offerings. They've got a company called NIO and BYD, which Warren Buffett is an investor in. But it doesn't seem to be the case. Chinese consumers and drivers are really excited about Tesla, and they're buying them at a rampant pace. One thing I need to point out, though, is that Tesla now currently is trading at 7 times sales, which is unheard of, right? It is 10 times more valuable in terms of that ratio than Toyota, which is now the second largest car manufacturer in the world because Tesla replaced them. So you're paying for Tesla not for this year's growth, but for the growth that you're going to see over the next 5 and 10 years.
So in terms of the actual car itself, do you think, I know that they are beginning to realize it now, but just in terms of the more straightforward manufacturing process for an electric vehicle, I'm just wondering if Joe Investor really kind of understood that, say, 2 years ago.
I think people are catching on. So there was this idea of a crossover point that was supposed to happen sometime in the future. Originally, analysts predicted it was coming in 2025, and then they pulled their expectations forward to 2023. And now we could see this crossover point where the electric vehicle becomes cheaper than the internal combustion engine in the next year. Now, one other thing I want to mention about Tesla, because it's not just about electric vehicles. So you have to think about the entire transportation sector. And this is a $7 trillion industry if you consider trucking and ride hailing and all types of different logistics like FedEx and UPS, and the vehicles that basically you use to move people and things around the world is a $7 trillion annual industry. And Tesla, because they have a technology that not only is cheaper to produce a vehicle, but they also are in the middle of the self-driving car race, investors are bidding the company up because they want to get into the stock and into these investments before that future becomes a reality. We saw this with Amazon. If you think about Amazon in 2011, everyone was saying how overvalued Amazon was. And there were plenty of bears out there saying, oh, don't buy the stock. They don't make any money. They're not profitable. And now look at Amazon today. The stock just kept moving up. It still has this tremendously high valuation, but they've just steadily been eating the e-commerce market and just destroying traditional retailers. And that's what people think Tesla will be doing for the entire transportation industry. So it's not just about making one electric vehicle, it's about how we move people and things in the future. And that's the narrative really that's driving Tesla shares right now.
Wow. And for example, even the the up and comers, if you will, the Nikolas of the world, they don't actually have a vehicle that they're selling yet, but their stock price is high. Their market value is in the billions and billions of dollars. And to some extent, to have that competition, quote unquote, whether it's valid or not, I mean, that's got to be good to keep Elon, doing things well.
Yeah. I mean, you love the competition, but it's crazy. Like Nikola is trading with a $20 billion valuation. They have no car. I think they had $400,000 in sales, which were like pre-orders this year. Then you've got Rivian, which makes an electric truck that's raised $2.5 billion in private markets. And then another company that I used to be an investor in, Fisker, is now expected to go public, and they're largely owned by the Chinese. But one thing I have to say about this is, so we own Tesla in Automatic Fortunes, and we got into it back in last August under 250. But every time that a new electric vehicle comes out, whether it was the Audi e-tron or the Jaguar I-Pace or the Ford Mustang electric, which isn't available yet, I would go to the dealership, I would talk to the dealers, I would look at the specs, I would test drive them if they would let me. And I would just figure out that these offerings that are trying to compete with Tesla are just so far behind in their technology that Tesla has this 7 to 10 year head start on all these auto manufacturers in terms of how much energy they can get from one battery on one charge. And it's just so tough for these other car manufacturers to compete. Now, with auto sales that have been hit because of coronavirus, there are auto companies that are starting to shelve their plans for electric vehicles. So they're realizing that there's no way they can compete against Tesla. And so they're just ditching their plans and trying to keep selling their internal combustion engines. This is like slow walking, into death. You can look at some of these automakers, and they are going to look like JCPenney and Sears and all those department stores that are now, defunct and bankrupt in 10 years when these new electric vehicles, really take the road. So I don't know. If I was an investor in GM or Ford at this point, I think I would be very cautious. Another thing on Tesla, look, it's had an incredible rally. It's up, I think, 70% just in the last month or so. So you got to be careful buying shares here. If it does pull back, which I think we will see a reversal at some point because it's starting to get out of hand, where people are just buying the stock because it's going up. If you do see a reversal, I think you want to get into it, because this is one of those companies, kind of like Amazon and Facebook and Netflix and Google, that is always going to feel overvalued, and people are always going to have, bear cases that sound reasonable, but you just have to keep looking at how this car company is eating away market share and how their technology is superior to everybody else's. So that's what I want to say about Tesla this week. I know we've got some other stuff to cover. JP Morgan earnings are coming out this week. We discussed this before our call. Do you want to give our viewers just a little highlight of what to expect with JP Morgan's earnings?
Well, J.P. Morgan and all the banks really are the main some of the main earnings news that we're going to get this week, and people are wondering, can they reverse this ship? We know that interest rates are next to zero, so how are they going to generate net interest margin when they can't? I mean, so then they're going to have to rely on their other products, their credit cards that still have, in my opinion, exorbitant interest rates. But if your customers who use your cards don't have a job, then what's the story? What's the reserve situation going to be? That's what we've seen the last couple quarters, is these banks reserving billions and billions of dollars for the potential losses that they feel they're going to face. We're going to see that continue this quarter. Is it going to be more or less than expected? And also, just kind of in general with respect to earnings, will we get any forward guidance? We saw companies largely remove that because they didn't know in the face of this pandemic. And they still don't for sure. But any insight that we can get, any new information will be helpful for us to accurately price banks and the other names.
Yeah, and can you just explain to our viewers exactly what net interest margins are? Because it sounds like a really fancy term, and I'm sure a lot of people don't really understand what that means when you're saying net interest margins. Just give us a quick rundown of what that means for bank earnings.
That's really just the difference between what a bank can loan money for and what it has to pay its customers for their funds. And what we're seeing is their loan rates their loan interest rates are falling, and of course then they're obviously not generating as much interest on the loans that they generate.
Mm-hmm. Yeah, I also think JP Morgan just has a bigger problem with, all this infrastructure though. And it's the same thing with Bank of America and Citigroup. Millennials don't want to go to the bank and stand in line. I mean, especially in the age of coronavirus. I can't tell you when the last time I actually went to the bank was. I have hit a few ATMs, but everything is going electronic, and it just seems that JP Morgan has all these legacy investments of bank storefronts, which will probably be CrossFits and yoga studios at some point. You really have to wonder, why would you buy JP Morgan when you can go invest in companies like Square and PayPal, which are really, disrupting the entire financial space? Any thoughts on the payment space specifically, Brian? What are your thoughts on Square or PayPal?
Well, really, I think the prices of Square and PayPal have and are reflecting and will continue to reflect exactly what you just said. If you look at JP Morgan's share price since the end of March, with the exception of one brief blip higher, which subsequently reversed, it's really been flat. Square and PayPal, to the moon.
Yeah. It's been an incredible run for Square, especially just in the last month or so, has gone, I think, from $80 to over $130 today. But we saw during coronavirus, you couldn't use cash. So you had to figure out if you, let's say, had someone, a contractor over, or a landscaper, or someone that you owed money to, and you didn't want to go to the bank to go get cash out. How do you pay people? And you can use the Cash App on Square or Venmo and PayPal, which also seems to be what the millennials do. But we saw a huge growth in Square's Cash App users from, I think, 15 to 30 million in the last year, and analysts are expecting it's going to be 50 million. And a bank like JP Morgan, it costs about $300 to onboard one new bank account. It costs Square $30. So they're advertising on social networks like Facebook and Twitter, and they're getting people to subscribe, just download their app, and basically just transfer money from their traditional bank to the Square Cash App, and creating this whole new financial plate of offerings for especially millennials that are using it right now, that they're able to do to kind of undercut the banks. And so, my long-term outlook on JP Morgan and Citibank and Bank of America is not very good because of that. Obviously, they've got these huge institutional departments that Square and PayPal don't have, but from the commercial side, from the retail side, I just don't see how they can compete against tech companies, essentially, Square and PayPal,
That's right. That's what we're seeing. And then also on the tech/entertainment side, we also have Netflix this week, and its stock has been quite strong as well. Any particular expectations there, or just kind of excited to see what they report?
Netflix is one that just perplexes me. It's obviously has a crazy high valuation, and there's just so much competition in space. How many streaming services? I don't even know how many streaming services I have. It's got to be I have everything. I went to go watch something on Hulu this weekend. This new movie called Palm Springs is a great comedy, and I didn't even realize I had a Hulu subscription. I haven't watched Hulu for a year, but I've been paying monthly. So, how does Netflix compete in this world? I guess people just have their Netflix subscription and then they add their own. But, your cable bill is going to go up with all these streaming. We're supposed to cut the cord and things are going to be cheaper. But the reality is we've got all these new cable subscriptions. Do you know how many subscriptions that you have?
Oh, we have no less. My daughter kind of manages them, and we have definitely two hands worth.
Oh boy.
We have whatever we need. And it's also one of those things where, with respect to Netflix, we hear this discussion of, they raised their monthly rate from $7.99 to $9.99 and wherever it is now. I mean, yes, some people might cut it off if it goes up $2 a month, but I don't think most will. So that's,
they keep coming out with, great programming. I think Netflix had 15 Oscar nominations last year, which how can you not own Netflix for $10 or $12 a month if you're getting Oscar movies?
That's exactly right. Well, and then we uncover stuff from time to time, like this with my youngest daughter. We started watching this show called Brainchild. I mean, it's wonderful. And it looked like Pharrell Williams was one of the producers. It's super super educational and presented at the appropriate level for her age. So, I mean, you can't beat it in many respects.
Interesting. I will say though, out of all the streaming services, and it doesn't factor too much into the valuation of the overall company, but Amazon Prime has the best algorithms to suggest what I want to watch. I find that what these streaming companies should do is basically tell you or guide you to what you might be interested in. I found that the picks that Amazon gives me are usually more on the mark than what Netflix does, and even Apple TV, which doesn't have enough offerings. But in that space, it's really just Hulu, Netflix, and Amazon Prime that have enough content that they can actually say, hey, you might be interested in this new show or this new content. So. But what do you think about earnings? Do you think the stock's going to go up or down?
For Netflix, I don't really know, but I think whatever it does, it's going to do it in a massive quantity. That's what it normally seems to do. That's these stocks, to me, stocks are they've been bid up, and obviously there are reasons why. It's hard for me to see some of the fundamentals. They don't jive, at least with history, but again, we have 0% interest rates, and multiples deserve to be a little bit higher than they historically were. But I'm interested, and actually in terms of just earnings season overall, I think for me it's something that I've been focused more on. It's kind of entertainment, but it's also you can make some real money when there are some stories that haven't been baked in, or vice versa, when the expectations are too high. So I'm actually excited that it's starting up again here.
Yeah, in this space though, I think the better play in the long run is probably going to be Disney. I mean, they have all the legacy kids content, and they've got Marvel now, and they've got Star Wars. So even though you're going to see some headlines where Disney in Florida is open now, and I heard just this morning they closed Disney Hong Kong, and I think at some point they'll probably have to close Disney Florida, unfortunately. But at that point, if people sell Disney stock, just imagine that at some point we're going to have a vaccine, theme parks will be open again. You're probably going to get the stock from someone that, wants the stock to go up now, and then they want to get rid of it. But then you've got the streaming business as well, which I think makes Disney a very compelling investment because of that. So
yes, indeed.
Yeah, yes, and you get the streaming for a lot less than you have to pay for when you buy Netflix, which is something 100 times earning or something crazy like that. But let's leave it there, Brian.
Yes, I agree. Ian, thank you. This was wonderful. We rambled a little bit, but it's because there's a lot of interesting things going on right now. So have a great week.
Thanks, Brian. For all our viewers out there, thanks again for tuning in, and we'll speak to you soon. Take care.
Also, you guys, please don't forget to subscribe if you haven't already. Look in the description at the bottom of the screen there, and thank you. We'll see you next week.